one day and it went over the fence, just like you see here. And I put that ball there and I wanted to see how long Blue would sit and stare at that ball. I even tossed another ball just inches by Blue. Yet Blue wanted that ball through the fence. It's the same thing I've seen with REOs. Agents don't want to get involved. Investors don't want to get involved consistently. Why? It doesn't matter what's sitting right by their feet. It doesn't matter that it's going to make them money. Their mindset and their philosophy is, I've got to have what's right. Almost that unobtainable aspect. So here's what Freddie and Fannie said, and here's what I found amazing with a room full of investors, and I want to share it with you. First of all, to get Freddie or Fannie REOs, this is exactly what you do. You go to their website and you fill out an online form. That's it, as an agent or investor. You fill it out and it's an application. It's a web application. You send it into space. In fact, you won't get a return confirmation. You just literally send it into space. No different than a prayer or putting positive thoughts out into the universe. You just send it out there and you hope for the best. They're not going to confirm that they got it. They're just going to accept your application. It's then when I saw somebody get up from one of the tables sort of shaking his head and leaving, and I thought, that's the guy I want to go speak to. I don't know why, I'm always into that kind of drama. And I stopped this guy before he left and asked him, why are you so frustrated with that? He goes, because it's crap. I said, well, why do you know it's crap? I mean, I know it's crap. Because I think it's funny that they're all sitting there and they're writing down notes thinking that they're possibly going to get REOs from either Freddie or Fannie by filling out a web form that doesn't even give you confirmation that they've received your information. But neither here nor there, why do you think it's crap? He goes, because I sat next to a guy who just sat and chuckled when they said it. I said, well, why was he chuckling? He goes, because he gets all the REOs in Southern California. He's actually the investor who gets the real spool for Southern California. And he was laughing the minute they explained this web form. I said, well, how did he get them? I already knew the answer, I just wanted to hear it. He said, well, he and a bunch of his buddies from Texas jumped on a plane and flew out and met the guy who's sitting up there on the stage, and they wined him and dined him until they got all the REO listings. That's the truth. I'm going to tell you what I know about REOs. It's not who you know. It's not how you get them. It's not your great work. It's not your diligence. And guess what? It's not your money. It's who you know. At the end of the day, it's who you know. Okay? When I was an REO asset manager, the gifts were better, the trips were better, the money was better. And if you don't believe that's happening, you're a freaking fool. That's the truth. This is about money. And people who really want REOs are prepared to spend and go after it. I have literally met with everybody who's chased an REO across the United States. And you guys already know this fact. They're impossible to get your hands on. Okay, what? You're going to get them on the retail market? You're going to get them through an agent? Okay, the average REO listing that hits the open market is going to be sold at top fair market value. Top. It will have 3 or 4 all-cash deals because the standard pocket investor wants a piece of the REO too. Because of the mindset, I got to have the ball through the fence. That's the part that blows me away. Short sales are sitting there, dangling by your feet, ready to make you all the money in the world. All the money you can humanly imagine. And with no risk. There's no risk in the setup. That's the part I find amazing. Why? Well, because the first people who came along and tried to teach short sales to investors taught inaccuracies. They taught concepts that would never work with an asset manager. Certainly, they weren't taught by somebody like me, who's a former, asset manager, head loss mitigator, who actually understands how the bank operates. So, what is it? So let's assume you're doing a short sale on an ABC equity spread, and I'm going to explain exactly what an ABC is in a minute. Let's assume, what is the average return on an ABC equity spread for someone? Truth? It's 18%. But, Lee, that's less than 25. I got to have the REO, because maybe I'll get 30 or 35. Yeah, you're right. This is consistently just 18%. And I'm sure that you can go out and invest your money with zero risk and make consistently 18%. I can think of literally millions and millions of ways of taking $100,000, investing it in a million different things that'll get me 18% with no risk. That's the thing here. There's no risk. I don't put up my money unless I know I'm making the 18%. That's the truth. It's what the elusive chase is of an ABC spread. So what the hell is an ABC? This is what nobody's ever taught you. So how does the ABC work? All right. The A is the seller. Okay? We're going to go through this inch by inch. The B is you. okay, the buyer. And C is the end buyer. So let's assume we have a 100K property, okay? The equity from fair market value, and that's what this is, it's a fair market value of 100K on your short sale, it's 100,000. What's the lowest number the bank will take right here between A and B? Now here's how it was taught. Submit 50 cents on the dollar, you wait for a counter, and that's the number. Wow, that's really good. People write them up under LLCs, they do them all cash, thinking the bank will give two craps about what they've submitted. And guess what? They decline the deal consistently. They do. So let's assume that I know what the lowest number is the bank will take between the two parties, A to you, the person watching this. And in this particular case, the lowest they'll take is $78,000. Okay? That's the lowest number. That means I'm shooting for an equity spread of $22,000 on this deal. Currently, I'm at a 22% return on my investment for all of you that I'm going too fast on. So I'm going to write up an offer right here between A and B at $78,000. And I'm going to say it's me. I'm buying it. Okay? While that's happening, I'm relisting the property to sell from me to the end homeowner. Fair market value of 100K. Again, creating my equity spread of 22%. Or $22,000 for the sake of our discussion here. $22,000 is not my end take. Again, the same person that I was talking to at this Norris event outside said, I hate short sales, I've got one right now. And he goes, I just submitted an offer that was 25% below fair market value and the bank won't take it. I said, yeah, because they make more by foreclosing on the property. By being a few percent above what it'll take for them to foreclose, the 22, he could have gotten his deal approved. It's the truth. Instead, he went for 25% below fair market value, and he was frustrated. Great. Okay. So let's make a blind assumption, okay, that I'm chasing this equity spread, and I get them to approve the 78K in the perfect universe. Right here. 78%, or 78K is approved here. I'm going to sell this at 100K. Minus costs, fees, and everything. At the end of the day, I'm going to make about $18,500 on this deal. Now, here's the gimmick and why it's a zero risk. I'm not going to put in my 78K right here until I know this is funded. That's a zero risk. I know this is funded. So it's going to go from A to B, B to C. If you want to use terminology, it's going to run and look roughly like a concurrent closing. Again, it matters on the disclosure to all the parties and disclosures to all the banking. You're going to need appropriate paperwork so that you don't get into all the problems that seem to happen around them. But I'm not going to put my 78K in until I know this 100K is in, funded, and ready to be wired. And therefore, I make the equity spread of, it's going to be about 20% at the end of the day. Really, ultimately, maybe as low as 18.5%. But that's what I was after, and I did it for an investment of 78K, and I did it with limited no exposure. No exposure. Worst case scenario, I don't work this deal out, and I send it down to the C person. I still cash flow. I'll still make money on the deal somewhere. Sure, it won't be 18.5, but I'll close a deal. I'll get the referrals. Maybe I make some commission. Maybe I make a little something else on the back end. But at the end of the day, I'm making money on this deal one way or the other. That's the truth. But we're still chasing the 25%, Lee. How do we get it, and where are the REOs? Really, you can't clearly see why everybody wants to work with short sales. The legality and everything that's involved with this is where it gets a little trickier. But that's the truth of working with these properties. So the question really starts to become, why hasn't anybody taught it right, and why hasn't anybody really worked with it? So why do investors hate short sales? Okay, the truth is they can't close A to B. Let alone, so forget C, forget the equity spread. Fundamentally, what I've seen out of investors is they jump into short sales willy-nilly. They try to close at 25 to 50% below fair market value. They wind up hating the bank, cursing the day they ever came across it, instead of knowing exactly what the numbers are or how to work a short sale process. This is the biggie. If you can't close the short sale, forget working on the equity spread. Forget me giving you the technical details of what it takes disclosure-wise, or even how to structure or set up the deal, or the paperwork you will need. The question is, can you close a short sale to begin with? Let's go with the basics. How do you close a short sale? So let's start right there. I think you guys deserve to find out what the basics on doing a short sale are. So let's start right there. You need to know the value, fair market value. You need to have a good offer. In this case, for the B, it's going to be your offer, okay? Generally about 80% of fair market value to chase my 18%. It's a little bit lower, so we're going to have to talk about bank numbers. You're going to need a good HUD, okay? What's the net payoff to the first and the second? This is it. This one fundamental step is the biggie that everybody screws up. What's the story being told? What's being prepared? What are my sellers thinking? What is everybody in this transaction? And with an equity spread, you've even got more players and more people involved on top of it. So it is all perception and mindset. So I'm going to take you through it on how to do a basic short sale. First and foremost, you're going to need a basic stack file with authorization, client information, hardships, financials, mortgage statements, pay stubs, tax returns, probably a CMA, cost of repairs, residential listing agreement, estimated HUDs. You're going to need this whole package, so let's go through it. This whole package has to be perfect for that aid to work. Your seller has to be in a correct mindset. They have to be appropriately educated, because if they don't, they will make huge mistakes. Okay, where does it happen? The hardship letter. There are 2 basic hardships, and everybody screws this up. I don't care what their hardship is. There are 2 that the bank care about. Number 1, I don't have any money. 2, I'm moving. That's it. That covers everything for you. I'm glad we could have this discussion. What you need to understand about this whole thing, it's a story. It's the story of unloaning money to the bank. And unless you can convey that story of my client needs to unloan himself, you're not going to be able to chase that equity spread. And these are the hurdles that are in front of you of making a no-risk 18%. You're going to need copies of last year's tax returns. This is another standard mistake. What do people do? They submit 150 pages of information. The bank uses the information to go after deficiencies. Do you think your client's going to want to close if they find out they're going to get a deficiency or an unsecured note for the remaining balance? I don't think that's really going to happen. So the truth is, this file has to be prepared perfectly so that my seller has the right mindset so that I can buy it at the lowest possible figure, let alone writing up. It's not hard for me to write up an offer that's, 22, 23% of fair market value so that I can chase my equity spread. What's my seller's mindset after doing all this paperwork? And here's the real reason why. It's this damn thing called a loan mod. Your sellers, the people you're doing marketing to that you want to make money on, have consistently been talking to the bank at the moment. And they've been doing loan modifications, which means they've been turning all their financials and all their data and all their records over, making themselves look good to the bank. And that's a serious problem when you're trying to do any kind of short sale transaction. And since we're just talking the basics of going from A to B, closing a physical short sale, let it be 22% below fair market value or 100% of fair market value. The issue becomes, what is my seller up to? And here's why. Let's say they've talked to the bank or they've submitted something and they've done a loan modification. On average, they get a trial loan mod, which is 1 year to 18 months of an adjusted payment schedule. Well, the truth is that they're going to submit all this information to the bank. Client information, authorization, hardship letters, financial statements, pay stubs, bank statements, tax returns. Now follow me. That's exactly what they want for a short sale. In a loan mod, the mindset of a seller is to prove themselves to look good. In a short sale, the mindset is to paint the seller as not having money. Once you do it this way, you can't undo it. So you need to approach the seller, you need to educate the seller, and these are the people you're going to market to.